This week we've seen the series of planned maintenances on the UK continental shelf continue. That's seriously restricting gas flows from the UK continental shelf into the UK. On top of that, we've seen changes in Langnad flows. Troll, which is a big Norwegian gas field, which is one of the main contributors to Langnad flows, is reaching its quota for this gas year. And as a result, we're seeing production at the field reduce so that they don't kind of breach that quota level. So going forward, we're now expecting also kind of Langnad flows to diminish from levels we've seen over recent weeks. In terms of LNG, we've been quite muted over the last few weeks, so kind of the schedule has been very, very sparse. Main reason for that is that we've seen increased demand from Egypt and Jordan, so Qatari gas has been rerouted to those two locations as opposed to the UK and Europe. However, going forward, we've got 4 potential cargoes en route, so we could see LNG send out increase over the short term. Looking at the power market now, in terms of renewable generation, we've started off the week very, very strong with wind power forecasted at around 7 gigawatts. However, because wind speeds have been so high, we've actually seen the actual outturn much lower than this 7 gigawatts, because when wind speeds are significantly higher than normal, we see turbines turn off for safety reasons. Going further forward into the week, we're expecting a much lower forecast of around 2 gigawatts as wind speeds reduce. In terms of nuclear power, we've seen Hinkley Point B7 come back from maintenance over the weekend, and that's gradually resyncing with the grid and getting back up to capacity. So going forward, some of that loss of wind power should be replaced by this return in nuclear generation. Finally, looking at the oil market, we've seen kind of renewed calls from OPEC members for a freeze in production, and that's seen kind of oil prices track a little bit higher at the start of the week. However, as previous, an actual production freeze is deemed quite unlikely because there's so many members involved in agreeing a price freeze in OPEC, and all with different motives and agendas. We've seen historically that they're very unlikely to kind of come to the negotiating table and agree a freeze. So on a day-to-day basis, we're still looking to operate with an oversupply in the oil market, and over the short term, that's actually poised to worsen as the US rig count is continuing to increase, and we've hit a fresh high since March 16 this week. So starting with day-ahead gas prices, we've seen them trade in a relatively broad sideward range since kind of May 16 time, and that's at about 15% above the low seen earlier in the year back in April. Looking at power prices, again, we've seen them trade relatively sidewards since May time, and they're fluctuating on a day-to-day basis on the changes in supply-demand fundamentals. Looking at seasonal prices now, gas and power prices have been falling over the recent weeks, driven by lower oil prices. However, that kind of short-term downtrend is paused in line with the kind of recovery we've seen in oil prices over the last few days. Looking specifically at oil, it's traded away from kind of 4-month low seen last week, up kind of back towards $45 a barrel, and the view is going forward there is potentially a bit more upside over the short term. So starting with customers with fixed price contracts, this recent downturn in prices has given you a renewed opportunity to enter the market and secure a better price. And when you do enter the market to do that, again, I would consider kind of challenging your recent strategic decisions and potentially look at maybe fixing a 24 to 36 months. And that's linked to the fact that we'd see a risk premium built into forward season. So year 1 would be more expensive than current year. Year 2 would be more expensive than year 1, where we're not currently seeing that risk premium built into prices. So if you fix for 3 years, you get in a roughly level price across those 3-year period. For customers with flexible contracts, again, the recommendation is quite similar. This downturn in prices is giving a renewed opportunity for you to increase your hedge level at kind of lower prices. Again, the recommendation will come down to your individual hedge levels. If you're quite highly hedged, there isn't necessarily the incentive there to increase that hedge further. However, if you've got quite low hedge levels, again, this is a real opportunity for you to enter the market and secure at least a proportion of your volume at cheaper prices.